So, picture this. It's late on a Thursday. You've just spent like 3 weeks building the perfect financial model.
Oh, we've all been there.
Right. And you have this massive spreadsheet proving that your proposed project, let's say it's some huge expansion into a new overseas market, will generate $50 million in net present value.
A guaranteed winner.
Exactly. The math is flawless. Your assumptions are backed by all the data. So you slide that beautifully printed deck across the mahogany boardroom table. The CEO picks it up, looks at the final number, looks back at you, tosses it into the trash can, and just says no.
And the silence in that room is just deafening.
It's the ultimate reality check.
Yeah.
So today, we are figuring out exactly why that happens.
Right.
To you, the MBA student listening to this deep dive right now, fueled by espresso and trying to conquer your final corporate finance exams, welcome.
Glad to have you here.
You already know the basics, right? You know the time value of money. You know how to calculate net present value. But today, we are taking on the final boss of investment equations. We're talking about capital budgeting under risk, uncertainty, and capital rationing.
Because honestly, the sterile laboratory of textbook finance is a lie. I mean, we operate in a world where the future is entirely unpredictable. And the corporate bank accounts used to navigate it are, well, strictly limited.
Super limited.
Yeah. So by the end of this session, you are going to understand the mechanics of why corporate giants reject guaranteed profit. You'll understand the psychology of risk, and you'll see how executives try to tame chaos using everything from certainty equivalents to Monte Carlo simulations.
Okay, let's unpack this. We really have to start with the concept that just shatters the textbook illusion completely, capital rationing.
Right.
In your intro classes, the rule was so simple. If a project has a positive NPV, you fund it. It adds value to the firm, therefore you do it. Limitless capital waiting to be deployed.
A beautiful fictional world.
Exactly. But when you step into an actual CFO's shoes, you realize you're staring at like 10 amazing projects,
Yeah.
and you only have the cash to fund 3.
And that is the core dilemma of capital rationing right there. You are trying to allocate a strictly limited budget across competing investment projects to, maximize shareholder wealth.
Right.
You aren't just picking the one project with the highest return. You're actually trying to find the specific combination of projects that squeezes the absolute maximum NTV out of your limited funds.
But let's dig into why those limits exist in the first place, because it's not always just a matter of being broke, is it?
No, not at all. Often a company has the total ability to raise more money, but they just choose not to.
And this is called soft rationing, right?
Exactly. Soft rationing. Think of this as a self-imposed diet. You have food in the fridge, you have a high credit limit, but you are actively choosing to starve your growth engine.
Which begs the question, why on earth would management do that?
It sounds totally counterintuitive, right? Until you look at the boardroom politics and, frankly, the survival instincts at play. Let's look at the first major reason for soft rationing, which is control.
Control. Okay, paint a picture for us.
Imagine a founder who has built a really successful mid-sized tech firm. They have a slate of incredible expansion opportunities. But to fund them, they'd have to issue a massive amount of new equity. They'd have to bring in heavy-hitting venture capital or private equity.
And the moment they do that, their ownership gets totally diluted.
Precisely. Suddenly, they aren't the undisputed king of the castle anymore. They have board members breathing down their neck demanding, specific exit strategies.
They lose their autonomy.
Exactly. The founder looks at that dynamic and says, I'd rather grow slowly and keep 51% of the voting rights than grow exponentially and become a minority shareholder in my own creation.
Wow, so ego really drives the math.
Ego and control. They self-impose a capital limit to retain absolute operational control. Furthermore, if they prove they can generate massive returns organically on a smaller capital base, their valuation will skyrocket.
So when they do finally decide to raise capital later, they'll give up significantly less equity for the same amount of cash.
You nailed it. That's the long game.
Okay, so ego and control are massive drivers.
Yeah.
But what about debt? If they don't want to issue equity, why not just go to the bank and borrow the money?
Well, that leads to the second reason for the self-imposed diet pure risk management. Management might be absolutely terrified of the fixed obligations that come with debt.
Oh, right. Because debt doesn't care if you're having a bad month.
Exactly. Let's say you borrow $50 million to fund these new projects. The math looks great today, but what happens if a recession hits in, say, 18 months?
Your revenues plummet, but those massive interest payments to the bank, they don't change at all.
Right. And suddenly you're facing a severe liquidity crisis. Most sophisticated firms operate with strict internal guidelines regarding their debt-to-equity ratios.
So they put a ceiling on their leverage.
Yes, they want to maintain bulletproof solvency metrics so that when the market does crash, they survive. They will stubbornly adhere to those internal limits, even if it means passing up a highly profitable project today.
That makes a lot of sense. Which brings up the third reason for soft rationing, which I find the most fascinating. It's the concept of keeping your powder dry.
Oh, yeah, the emergency reserve.
Right. Managers know they don't have a crystal ball. They are operating in highly imperfect markets.
Definitely. A positive NPV project today might look like a total joke compared to the golden opportunity that lands on your desk next Tuesday.
So if a firm ties up every single dollar of its capital budget on Monday, and a competitor suddenly goes bankrupt on Tuesday, offering a fire sale acquisition,
You miss it, you're locked out.
because capital takes time to raise.
Exactly. By the time you float a bond or issue new stock to buy that competitor, someone else has snatched them up. So companies artificially limit their spending to ensure they always have an emergency reserve of deployable cash.
Always keep the powder dry. So that's the internal diet.
Yeah.
But what about when the diet isn't a choice? What about hard rationing?
The dreaded hard rationing.
My favorite analogy for this is like getting to the checkout counter with a cart full of groceries, swiping your card, and just seeing declined.
It's a terrible feeling.
You want to spend. The math says you should spend to grow, but the external markets have completely cut you off.
And this happens far more frequently than MBA models suggest, and it hits companies at literally every stage of their life cycle.
Really, like even startups.
Oh, especially startups. Take the classic biotech startup. You might have a young firm that has just discovered a revolutionary compound. The projected returns are astronomical. The NPV is off the charts.
But they have no money.
Right. And when they walk into a traditional bank, the loan officer just laughs. The startup has no assets to collateralize and absolutely no track record of revenue. The external market refuses to provide the capital.
So that's early stage. But it's not just startups, right? Mid-sized companies get caught in this trap constantly.
They do. Imagine a solid, profitable manufacturing firm. They aren't listed on the public stock exchange, which means they don't have the broad visibility or the SEC-regulated credibility to just issue corporate bonds to the general public.
So they're stuck relying on local banks.
Exactly. They rely entirely on a small syndicate of regional banks. If those specific banks decide to tighten their lending standards because of, say, a macroeconomic scare, that mid-sized company is completely locked out of growth capital.
No matter how good their projects are.
Exactly. And even the corporate behemoths face hard rationing, usually in the form of bank covenants.
Oh man, covenants, the silent killers of ambitious projects.
They really are. Think about it from the lender's perspective. If a mega bank loans a Fortune 500 company $1 billion, they are going to write legally binding restrictions into that contract.
Like you can't borrow from anyone else.
Precisely. They might stipulate that the company cannot take on any additional long-term debt until the original $1 billion is paid off. The bank wants to protect its position in the capital structure.
Right. So the company might have an incredible new project, but their hands are legally tied by their past borrowing.
They literally aren't allowed to fund it.
Okay, so whether the CFO put a lock on the wallet or the banks did, the reality is the same. You have a mountain of projects and a molehill of cash. How do you actually sift through the pile?
In practice, companies use a highly efficient three-step rationing process. It's essentially an escalating series of hurdles.
Right, because when you have, 500 project proposals submitted from various divisions across a global company, you simply cannot afford the thousands of analyst hours required to run a full probabilistic NPV model on every single one.
It's impossible. You need a fast, brutal funnel.
So step one is what I call the bouncer. This is the initial screening phase. The CFO sets a hard rule, a maximum desired payback period.
Let's say 3 years.
Right, 3 years. The analysts look at all 500 proposals and run a quick rudimentary calculation. If a project takes 5 years to pay back its initial investment, the bouncer throws it out into the street. It's out.
Now, any finance student worth their salt is screaming at their headphones right now.
I know I would be.
They're saying, wait, the payback period is an academically flawed metric. It completely ignores the time value of money, and it ignores all the cash flows that happen after the payback date.
And academically, that outrage is completely justified.
It is.
So why do the smartest companies in the world still use it as step one?
Because of pure operational efficiency, it costs almost nothing to calculate. The payback period is a blunt instrument used to clear the brush.
So it's just a time saver.
Exactly. If a project in a capital-constrained environment takes 12 years just to break even, you don't need a sophisticated risk-adjusted discount model to tell you it's a terrible use of limited funds.
Right, you just kill it early.
Yes. Step 1 sacrifices academic purity to save time, isolating only the projects that warrant serious scrutiny.
Which brings us to step 2, the interrogation. We've fired the bouncer, and now we bring in the scalpel. The surviving projects get the full treatment.
This is the heavy lifting. This is where analysts build the complex models, forecasting out cash flows, discounting them back at the firm's specific cost of capital, and calculating the true net present value and internal rate of return.
You are definitively establishing whether these projects actually create shareholder wealth. Any project that spits out a negative NPV at this stage is eliminated.
Done. Trashed.
But remember, we are in a capital rationing scenario. Even after step 2, you might have 50 projects that all have a positive NPV, and you still only have the cash to fund 20 of them.
Yeah, you're still broke relative to your opportunities.
That sets up step 3, the draft. How do you pick your starting lineup? You take those 50 survivors, and you rank them.
Usually, firms use the profitability index here.
Which is simply the present value of future cash flows divided by the initial investment.
Exactly. It's a measure of capital efficiency. It tells you exactly how much value is being created for every single dollar you invest.
So you rank them from the highest profitability index down to the lowest. And then you just start drafting. You take the number 1 project, subtract its cost from your budget, take number 2, subtract its cost. You keep going down the list until your bank account hits absolute zero.
And the projects that fall below the funding line, even if they have a positive NPV, they go to the waitlist.
They become the powder dry options we discussed earlier.
Right. If a funded project suddenly falls through, or if the company finds a way to raise more cash next quarter, they pull from that waitlist. Capital rationing is entirely about maximizing aggregate return within unyielding boundaries.
But let's take a massive step back for a second. We've just spent all this time talking about sorting these projects based on their NPV. But the cash flows driving those NPV calculations are forecasts.
They're guesses.
Right. They are educated guesses about what the world will look like in 3, 5, or 10 years. And if the last few years have taught us anything, it's that the world does not care about your spreadsheet.
Not even a little bit. We have to move from the illusion of certainty to the actual management of risk. And we need to be very precise about our definitions here.
Let's define it for the MBA students listening.
When a corporate finance executive talks about risk, they aren't just talking about a generalized fear of failure. Risk is defined mathematically as the probability that the actual realized cash flows will differ from the expected cash flows you modeled.
So it's variance.
Yes. It is the quantifiable chance that your supposedly positive NPV will actually manifest as a massive loss.
To deal with that, we have to measure it. We need a statistical toolkit. So let's look at the first tool in segment 2, range. I like to call this the quick glance.
It is the most rudimentary measure of dispersion. You simply take the best possible financial outcome of a project and subtract the worst possible outcome.
So if your optimistic scenario shows a profit of 10 million, and your pessimistic scenario shows a loss of 2 million, your range 12 million.
Exactly. It gives you a sense of the project's wingspan. The larger the range, the higher the inherent volatility.
But it's almost useless for actual decision-making, isn't it?
Completely useless. Its fatal flaw is that it only acknowledges the 2 extreme poles of reality. It tells you absolutely nothing about the probability of those extremes actually happening, nor does it tell you anything about the cluster of highly likely outcomes in the middle.
It's like evaluating the weather of a city by only looking at its all-time record high and record low temperatures.
That's a perfect analogy. You'd think Chicago is totally uninhabitable if you just looked at the extremes.
Which means we need to upgrade to tool 2, standard deviation. This is the heavy hitter. This is the absolute measure of risk analysis that every MBA student will be tested on.
Oh, absolutely. Standard deviation measures how widely the actual outcomes are expected to disperse around the average or mean expected outcome.
Think of it like a rubber band anchored to your baseline expectation. How far can reality stretch away from that anchor before it snaps?
That's a great visual.
I want to paint a vivid picture here without getting bogged down in reading formulas to our listeners. Imagine you're a CFO comparing 2 wildly different projects. Project X is an upgrade to your existing logistics software.
Okay, sounds pretty standard.
It's boring, it's predictable. You run the probabilities, and the expected average return is $6,000. In the absolute best case, it makes $8,000. In the worst case, it makes $4,000. All the potential outcomes are tightly clustered around that $6,000 expectation.
So when you calculate the standard deviation for Project X by finding the variance of all those possibilities and taking the square root, you get a relatively low number. Let's say it's roughly 1,100.
Right.
That tight cluster means a low standard deviation, which mathematically defines it as low risk.
Now let's look at Project Y. This is a speculative R&D project. It's a moonshot. You calculate the probabilities, and the expected average return is actually higher. It's $8,000.
Okay, higher return.
But the outcomes are violently dispersed. If the tech works, it could make $12,000. If the tech fails, it drops to $4,000.
What's fascinating here is that because those outcomes are spread so far away from the mean, when you run the math, the standard deviation for Project Y explodes.
It's huge, right?
It comes out to nearly 2,100. It is statistically almost twice as volatile as Project X.
And here is the ultimate managerial dilemma. Project Y is undeniably riskier, but it also promises a significantly higher expected return. The statistics have done their job, they've quantified the landscape, but the math cannot make the decision for you.
Exactly. And this is where finance transitions into organizational psychology. The choice between Project X and Project Y depends entirely on the risk appetite of the board of directors.
So different companies will make different choices.
100%. A legacy company desperate to protect its dividend will look at Project Y's standard deviation of 2,100 and run away in terror, happily accepting the boring safety of Project X.
But a startup.
A hungry, aggressive challenger brand will look at Project Y, accept the volatility as the cost of doing business, and chase the higher expected value.
But wait, I'm looking at standard deviation and I see a massive blind spot here. It's an absolute measure. What happens if I'm comparing the risk of a $10,000 software upgrade against the risk of building a $100 million manufacturing plant?
Oh, this is the trap.
The standard deviation on the massive plant is going to be a huge number simply because the cash flows are larger. It's going to look terrifying, even if the proportional risk is actually quite low.
That is the exact trap analysts fall into. You cannot use standard deviation to compare projects of vastly different sizes. You are trying to compare apples to watermelons.
So how do we fix that?
To solve this, you need a great equalizer. You need Tool 3, the coefficient of variation, or CV.
Standard deviation seems perfectly fine. Why do we need to complicate it with another formula? How does CV level the playing field?
Well, it transforms an absolute number into a relative ratio. The math is beautifully simple. You just divide the project's standard deviation by its expected cash flow.
Okay.
What you get is a metric that represents the risk per unit of return.
Oh, that makes sense. Let's apply that to our previous example so the MBA students can visualize it.
Right.
Project X had a standard deviation of 1,100 and an expected return of $6,000.
Right.
You divide 1,100 by 6,000 and you get a coefficient of variation of about 0.18.
And Project Y had that wild standard deviation of 2,100 with an expected return of $8,000. You divide 2,100 by 8,000, and you get a CV of roughly 0.26.
So even when we adjust for the fact that Project Y expects to make more money, its risk per unit of return 0.26 versus 0.18 is still substantially higher.
CV strips away the illusion of scale. If an MBA student remembers one thing about statistical risk, it should be this. When projects are different sizes, standard deviation will lie to you. Always use the coefficient of variation.
Always use the coefficient of variation. Okay, second 3. We've identified our capital constraints, and we've mathematically measured the exact volatility of our projects.
We have numbers.
But identifying a hazard isn't the same as mitigating it. Now we must translate that statistical risk into our actual financial models. How do we punish a risky project in our spreadsheets so we don't accidentally fund a disaster?
That brings us to the conventional risk adjustments. We've talked about the payback period as a bouncer, but companies use it as a formal risk adjustment tool as well.
Right.
And it targets one very specific type of terror, the sheer unpredictability of the distant future.
Because forecasting is kind of a localized illusion, isn't it? A good analyst can probably guess what sales will look like next quarter. They might have a decent idea about next year. But what about year 7? What about year 10?
It's pure fiction. The macroeconomic environment could flip. A competitor could drop a paradigm-shifting technology. Supply chains could collapse. Look at what happened a few years ago.
Right. So by enforcing a strict, short payback period, demanding that a project return its initial investment in, say, 3 years management, is aggressively truncating their exposure to that long-term fog.
They're essentially saying, We refuse to bet the company's money on what the world will look like in half a decade. It is a blunt, crude adjustment, but if liquidity and rapid survival are your primary concerns, it is highly effective.
Get your money back fast, and you limit your exposure to long-term unpredictability. But if we want to be mathematically sophisticated, we have to look at the discount rate. Let's talk about method 2, the risk-adjusted discount rate, or RADR.
This is probably the most intuitive adjustment for students to grasp.
Right. In a standard NPV calculation, you discount future cash flows back to the present using a rate that reflects the time value of money, usually the firm's cost of capital, or a risk-free rate like a government bond yield.
But if a project is inherently volatile, treating its cash flows as if they are as safe as a government bond is financial malpractice.
You can't do it.
No. The RADR method dictates that you must penalize that project by artificially increasing the hurdle rate. You take your base rate and you stack a risk premium right on top of it.
So if the safe rate is 6%, but the project is launching an untested product in a volatile emerging market, management might look at it and say, bump the discount rate to 14%.
And by inflating that denominator in the present value equation, you absolutely decimate the present value of those future cash flows.
You're shrinking the projected profits.
Exactly.
Yeah.
You are mathematically dragging the project's NPV down to reflect the danger. The decision rule here is simple. If the NPV manages to stay positive even after being punished by a 14% discount rate, then the project is robust enough to accept.
But I see a massive structural flaw in doing this. If you put the risk premium directly into the discount rate, that rate compounds exponentially year over year.
That's the math, yes.
Doesn't that mean you are implicitly assuming that the risk of the project is compounding exponentially over time?
Yes. That is the fatal flaw of RADR. By year 10, a 14% discount rate will obliterate almost the entirety of a cash flow's value.
Right.
But what if the risk isn't compounding? What if the project is building a pharmaceutical manufacturing plant and the only real risk is whether the FDA approves the drug in year 1?
Oh, wow.
Once the drug is approved, the cash flows for the next 9 years are practically guaranteed monopolies.
In that scenario, RADR would unfairly penalize those safe later years, potentially killing a wildly profitable innovation just because of a math quirk.
Exactly. And that realization forces sophisticated firms to adopt method 3.
Here's where it gets really interesting.
It does. It's the certainty equivalent approach, or CEA. Instead of tampering with the discount rate, which distorts the time value of money, CEA fixes the problem at the source. It adjusts the cash flows themselves.
This requires a fascinating psychological exercise. To find your certainty equivalent coefficient, which we call alpha, you have to negotiate with yourself.
Yes, you do.
Let's say your model expects a risky cash flow of $100,000 next year. It might be $150,000. It might be $50,000. As the decision maker, you have to ask yourself, what amount of absolute, guaranteed, locked-in-a-vault cash would I accept right now to walk away from that risky $100,000?
You might look at the market volatility and say, I'm risk-averse. Give me $75,000 in cold, hard, guaranteed cash, and I'll trade you the risky $100,000.
Right, so you divide the guaranteed $75,000 by the expected risky $100,000, and your alpha is 0.75.
That's your coefficient.
Then you take every future forecasted cash flow for that project and multiply it by its specific alpha. You might use an alpha of 0.8 for year 1 and an alpha of 0.6 for year 3 because the future gets murkier.
What you have accomplished there is a mathematical cleansing. You have purged the risk from the numerator. Those adjusted cash flows are now considered theoretically certain.
And here's the magic trick. Because the cash flows are now certain, you do not use a risk-adjusted discount rate. You discount them using the pure, unadjusted risk-free interest rate.
It is theoretically beautiful. The certainty equivalent approach cleanly separates the manager's risk preference from the time value of money,
Which RADR lazily smashes together.
Exactly. CEA is the superior tool, even though forcing executives to honestly define their alpha is incredibly subjective.
So we've adjusted our formulas. We have a single penalized NPV number. But let's be real. Presenting a single number to a skeptical board of directors is a great way to get laughed out of the room.
Oh, they will tear you apart.
They don't just want a number. They want to see the mechanics of failure. They want to know exactly what happens when reality doesn't match the spreadsheet. We have to test the future.
This is segment 4, the advanced toolkit.
Let's open it up. The first and most common tool is sensitivity analysis. When an analyst builds a cash flow forecast, they are stacking dozens of assumptions on top of each other.
They're guessing the market size, the unit selling price, the variable cost, the inflation rate, all of it.
Right. So sensitivity analysis isolates those assumptions to see which ones are load-bearing. It's the one variable test.
You define the underlying mathematics of the project, and then you change just one input while holding every other variable perfectly constant.
Just to see how wildly the final NPV swings. Let's illustrate why this matters for the students. Imagine you have two competing projects, Project A and Project B.
Okay.
Using your most likely assumptions, both projects spit out a positive NPV of exactly $12,000. They look identical, but you can only fund one.
So you run a sensitivity test on the unit selling price. You look at the pessimistic scenario. If the price drops slightly, Project A's NPV craters from a positive $12,000 to a devastating negative $21,000.
Whoa, so it is hypersensitive to price.
Exactly. But when you apply that same pessimistic price drop to Project B, its NPV only drops to a positive $1,900.
Sensitivity analysis hasn't made the decision for you, but it has revealed the hidden stakes. Project A is a glass cannon. One slight breeze and it shatters. Project B is robust. It can absorb a hit and still add value. The manager's choice entirely depends on whether they are a risk taker choosing A for the upside or risk-averse choosing B for safety.
But let's be honest, sensitivity analysis relies on a massive economic fallacy.
Oh, big time.
It assumes you can change one variable in a vacuum. If you drop your unit selling price in the real world, you can't just hold your sales volume constant.
Basic economics dictates that if price drops, demand should spike.
Right. You've hit on the exact reason why sensitivity analysis is only a starting point. It completely ignores correlation. To fix that, analysts use scenario analysis.
Instead of tweaking isolated variables, you bundle them into cohesive, internally consistent universes. It's the bundle test.
Let's look at an example.
Say you're evaluating 3 futures for a new project.
Yeah.
Scenario 1, moderate appeal with a modest price. Scenario 2, a large market, but it's highly price sensitive. Scenario 3, a small market that supports a high price.
Every variable in the model moves together logically to reflect that specific strategy. The spreadsheet calculates the revenues, subtracts the adjusted costs, accounts for the tax implications,
And produces an NPV for Scenario 1 and totally different NPVs for 2 and 3. Firms also use a simpler version of this, right? Base case, best case, and worst case.
Right. Best case bundles high demand, premium pricing, and perfectly efficient costs. Worst case bundles a recessionary market, price-slashing competitors, and supply chain cost overruns.
So the goal isn't necessarily to predict the exact future, but to establish the absolute boundaries of a project's fate. What is the theoretical zenith of success, and what is the nadir of failure?
Exactly. You map the perimeter.
Okay, so sensitivity looks at one variable. Scenario bundles a few. But what if the CFO looks at you and says, I don't want 3 scenarios. I want to see every possible combination of every variable all at once.
That's when you hand the keys over to the machine. Let's talk about simulation analysis, specifically Monte Carlo.
This is where capital budgeting truly enters the modern era of advanced computing, right?
Oh, absolutely. Monte Carlo simulation acknowledges that human-designed scenarios cannot capture the infinite, subtle, simultaneous interactions of dozens of shifting variables.
How does it actually work in a live corporate environment?
Instead of plugging a static number into your model saying, market demand will be 100,000 units, the analyst inputs a probability distribution. They tell the software demand is most likely 100,000, but it follows a normal bell curve with a standard deviation of 10,000.
Okay, and you build these distributions for every single input: price, variable costs, inflation, asset residual value.
And then the computer takes over. In a fraction of a second, it randomly draws one value from the demand distribution, one from the price distribution, one from the cost distribution. It plugs all those random but statistically constrained numbers into the model and calculates a single net present value.
That is one simulated future.
Then it wipes the slate clean and does it again. It runs this iteration thousands, sometimes tens of thousands of times.
So the output isn't just a single estimate. It's a massive visual continuum. The executive gets a chart showing a sprawling probability distribution curve of the NPV itself across 10,000 simulated universes.
The power of that visual is immense. The CFO doesn't have to guess. They can look at the data and say, based on 10,000 simulations, there is an 82% statistical probability this project achieves a positive NPV, and there is only a 3% chance we lose more than $5 million.
It sounds like the ultimate corporate cheat code.
Yeah.
Having worked with these models, I have to push back a little.
Sure.
Isn't there a massive garbage in, garbage out problem here? The computer is just drawing numbers from the probability distributions the human analyst built.
Right.
If an analyst really wants a project approved to get their end-of-year bonus, couldn't they just quietly tighten the standard deviation on the cost estimates? They construct a bell curve that fundamentally underestimates risk, and suddenly the Monte Carlo output looks incredibly safe.
You've just described the darkest secret of financial modeling.
Yes.
The output of a Monte Carlo simulation looks so scientifically rigorous, so mathematically dense, that boards often accept it as absolute truth.
It looks like science.
But if the foundational probability distributions are infected by human bias, or worse, active manipulation, the simulation doesn't eliminate risk. It actually creates a terrifying false confidence. The board thinks they have a 1% chance of failure, when in reality, the foundational assumptions were rigged.
That is a chilling thought for an MBA student to carry into their first job. Now, Monte Carlo simulates random variables. But what if the future isn't just about random chance? What if the future is dictated by sequential human choices made after the project launches?
That leads us to the final tool, the decision tree approach. A decision tree maps out the value of managerial flexibility over time. It is a graphic presentation that looks literally like a branching tree, intertwining present choices with future probabilistic events, which then lead to subsequent choices.
I always compare this to a choose-your-own-adventure book. You don't just read straight to the end. Let's say we are a tech hardware company exploring a massive leap into virtual reality headsets.
Okay, great example. Step 1 is defining the initial proposal, the root of the tree. Do we immediately build a billion-dollar mega factory to capture the global market, or do we build a small $50 million pilot plant to test the waters?
So you draw two branches representing those alternatives. At the end of each branch, you hit a chance note. This is where the market reacts. Let's say there's a 60% chance of high demand for VR and a 40% chance the market rejects it as a gimmick.
If you built the mega factory and demand is low, that branch ends in a catastrophic financial loss.
Game over.
But if you built the small pilot plant and demand turns out to be high, you encounter a new decision node. Now you have options. Do you rapidly expand the pilot plant? Do you license the tech to a bigger manufacturer? Or do you just run the small plant at maximum capacity?
You estimate the probabilities for every single twig on that sprawling tree and roll the expected values backward. What a decision tree reveals is something a static NPV model completely misses: the hidden financial value of the abandonment option or the expansion option.
Sometimes it is mathematically worth taking a lower initial return specifically to buy yourself the flexibility to pivot in year 2. It is the ultimate tool for strategic, multi-stage planning.
So, we have spent nearly an hour exploring the absolute pinnacle of corporate finance theory: capital rationing constraints, standard deviations, the elegant certainty equivalent approach, Monte Carlo simulations crunching 10,000 futures.
It's a lot of math.
It is. The math is rigorous. The logic is flawless. But as these MBA students prepare to graduate, close the textbook, and enter the actual workforce, we have to ask the ultimate question. Do real companies actually use all this heavy math? Let's dive into segment 5, real-world application.
This is where academic theory collides violently with human behavior. Researchers like Kolb, Klammer, and Pike have spent decades studying this, and they all reach a similar conclusion. A perfect Monte Carlo simulation means absolutely nothing if the organizational culture doesn't respect it.
Success depends on the structural setting, not just the technical apparatus.
Exactly. And the research reveals what you might call the paradox of payback.
Yes. We spent the first half of this deep dive explaining why the payback period is mathematically weak. It ignores the time value of money. It ignores long-term cash flow entirely. Academics hate it.
But what do sweeping studies by Velez, Nieto, and Gupta actually show about corporate behavior?
They show that despite all the academic warnings, the payback method remains wildly popular globally. And it is frequently the most utilized technique in emerging markets like India.
It's true.
So what does this all mean? How is that possible? Why are highly paid executives ignoring the advanced math they learned in business school?
It comes down to practicality, the limits of forecasting, and, frankly, executive impatience. Put yourself in the shoes of a CEO whose average tenure is only 4 or 5 years.
Okay.
When an analyst brings them a 10-year discounted cash flow model showing massive profits in year 8, the CEO knows that model is essentially a work of fiction.
And they might not even be at the company in year 8 to see the reward.
Exactly. But the payback method, it answers the one visceral question every executive intuitively cares about: when do I get my money back?
So it's a blunt instrument for liquidity.
Yes. It guarantees that capital is returned quickly, mitigating immediate risk and funding the next operation during the CEO's actual tenure. It perfectly matches the short-term pressures of real-world executive survival.
But surely the mega corporations aren't just using the payback method.
No, the research is highly nuanced. A famous comprehensive study by Graham and Harvey highlighted a clear divide based on company size and resources. Large multinational firms do rely heavily on present value techniques, NPV, IRR, and sophisticated models like the capital asset pricing model.
Because they have entire floors of analysts, expensive software, and the structural patience to run complex valuations.
Right. Whereas small firms or entrepreneurial startups cling heavily to the payback criterion. Their survival depends entirely on immediate cash flow, not theoretical 10-year returns.
Interestingly, studies by Sandel and Jogren found that public sector companies, specifically looking at infrastructure projects in Sweden and India, are actually the most frequent, rigid users of discounted cash flow methods.
Which makes perfect sense. If you are building a hydroelectric dam with taxpayer money, it's a massive, multi-decade project subject to intense bureaucratic and public scrutiny.
You don't have the luxury of a founder just going with their gut.
No, you need the rigorous, highly documented justification that a DCF model provides to defend the decision to Parliament.
So, synthesizing all of this for the MBA student listening, you must master the complex math. You need to know how to calculate a coefficient of variation and interpret a Monte Carlo output to satisfy the rigorous demands of the global corporate giants and the public sector.
You absolutely have to speak the language of high finance.
But equally importantly, you cannot be an academic snob. When you're dealing with small businesses, aggressive founders, or real-world executives who are impatient with theory, you must respect the intuitive power of the payback method.
You have to bridge the gap between the textbook's perfect logic and the boardroom's messy human reality. Master these tools not just to pass the finance exam, but to be the person in the boardroom who can calm the chaos of uncertainty with structured mathematical logic.
Right. Let's recap the journey we've taken today. We started by shattering the illusion of limitless funding, exploring how internal egos and external bank covenants enforce capital rationing.
We learned how to measure the statistical variance of the future using standard deviation, and why the coefficient of variation is the true equalizer.
We examined how to penalize our spreadsheets, either by aggressively inflating the discount rate through RADR or by stripping risk directly out of the cash flows using the psychological negotiation of certainty equivalence.
We peered into alternative futures, testing assumptions with sensitivity analysis, bundling them with scenario analysis, unleashing algorithms with Monte Carlo simulations, and mapping our strategic flexibility with decision trees.
And finally, we grounded that theoretical elegance in the pragmatic reality of global corporate practice, acknowledging that sometimes a CFO just wants to know when they'll get their cash back.
Exactly. And as you close your textbooks today, I want to leave you with a final provocative thought. We have spent an hour discussing how to use complex statistical models to tame risk.
We use historical variances to predict standard deviations.
Right, we use past data to build the probability distributions for our Monte Carlo simulations. The entire architecture of capital budgeting relies on the assumption that the future will vaguely resemble the past.
Which honestly feels increasingly dangerous.
It does. Consider this. What happens when the models themselves become the primary risk? We are operating in an era of unprecedented global disruptions, black swan events, AI restructuring entire industries overnight, pandemics, sovereign debt crises.
These are events that have literally never happened before in modern financial history.
Can historical standard deviations truly capture tomorrow's unprecedented structural uncertainties?
If the underlying physics of the market change, the math just stops working.
Exactly. If a Monte Carlo simulation looks at the last 20 years of data and tells you an event is a 1 in a million risk, but the entire geopolitical structure of the global economy just shifted yesterday, is that model protecting you?
Or is it lulling you into a catastrophic false sense of security?
Right. When you finally take your seat at the head of that boardroom table, and your flawless million-dollar model tells you one thing, but the chaotic world outside the window is doing something entirely different, will you trust the algorithm? Or will you have the courage to trust your gut?
A perfect reminder that the diagnostic machinery of corporate finance will always be a little bit broken. The muddy waters of the real world are waiting for you. Dive in.